The first question actually is for Bruce. I know initially you had mentioned something about rule changes in January 10th. I mean, June 10th. No, it was January 10th, yeah. There's some rule changes.
The Dodd-Frank rules for lending. So anybody in the mortgage business has gradually been dealing with more and more restrictive loan policies. January 10th, the full brunt of Dodd-Frank kicks in. The problem is they don't know what the full brunt of Dodd-Frank is yet. They've only had 3.5 years to work on it. So there's still a lot of decisions to be made, and that's not a joke. But it's going to make qualifying for loans harder because there's penalties for making loans to people that can't pay it back. On the other side of that coin there'll be a lot of private money waiting on the sidelines to see what the final rules are in January 10th, because they will step in, and there's what I've been told is literally trillions of dollars waiting to loan money on real estate at a little bit higher rate than currently the market is paying. But that would make a lot of sense. So I'm not too concerned about it. Uncertainty is the worst enemy of what we have right now. No one really knows what the rules are, and we're about to find out, I hope.
All right. Not a lot of questions. Okay.
I have one here. Hi, Bruce. My name is Liza. I'm a real estate broker, and I still have a lot of clients that are looking to find properties at 50, 60 cents on the dollar. Have you found properties like that anywhere?
It's certainly a rare find. We just had one recently where somebody found a property at $90,000. They flipped it to us for $10,000 profit. And we were doing a plan about what we were going to do with it and stuff, and we decided not to touch it and just put it in the MLS. And some people that were wanting it worse than us paid $156 for it, and we didn't touch it. And it had a termite damage report that if those guys quit holding hands, it's going down. To answer your question honestly, no, that's a waste of time right now. In this market, they're going to have a discount of 20 to 25%, be more likely, okay, minus repairs. So we still have to have a profit margin in there, but there's too much competition unless you were buying something that's really a mess directly from a person. If it hits the MLS, apparently it's going to get bid up.
My question is for Teresa. On the charitable remainder uni trust, is there a maximum amount of years that you can have that for? Can you have it for more than one? Like if you're married, can you do it yourself and then your spouse also?
It's your lifetime or 20 years. That's the max.
Oh, okay. Wow.
But the longer it goes for that you're getting money, obviously the smaller your deduction is. But if you're not caring so much about the deduction, then that's your term.
And that deduction is that maxed out at 5 years or no?
The deduction is the year you make the gift.
Okay.
That's your charitable deduction.
Okay.
But like I said, you're giving $1 million. You're not getting $1 million deduction.
Okay.
It'll be determined based on a present value.
Oh, I understand. Okay.
And the longer term you're getting money back, the lower that deduction is going to be upfront.
Thank you.
I think he might have been referring to the carryover. If he can't, I'm over here. If you can't use all the charitable deduction in 1 year because of tax purposes,
oh,
you can
right,
carry
yes,
over.
right, yeah. And definitely that is something to keep in mind when doing these too. You know, you do have limits on the amount of charitable deduction you can take, so that might apply too.
Okay, I got another question here.
Hi, my question is for Karen. You had said if you buy a property through your self-directed IRA, you can't be directly giving services, but then if you collect rent checks, and forgive me if this is a stupid question, are you able to collect the rent checks, or do you have to have a management company do that?
It's an excellent question. It really is. What you're allowed to do is really 3 things. You can screen tenants, you can pick up and collect the rent checks that are made payable to the IRA, and you can hire third-party vendors. So you are allowed to do those things. Screen tenants, collect the rent checks and send them into the IRA to be deposited, and hire third-party vendors.
Karen, I have a question for you. Fraud. Can you talk a little bit about maybe how to protect people from fraud, because it seems to be happening a lot in the IRA space, and you've got a really good story about one that you just helped stop.
Yeah, I do. Well, with IRAs, you just want to be really careful who you're investing with. I mentioned that a little bit when I was talking. Of course, there could be fraud in anything. So I think the number one thing is we're always looking for it. Sometimes we get a direction of investment. Somebody has hacked an email of somebody who sent us a direction of investment form, and then we get a new investment form asking us to send money out to a new set of wiring instructions. But what we're going to do is we're going to call those people first and say, hey, look, we got a new set of wiring instructions from you. What are you reinvesting? So we've stopped fraud in that way a couple of times. On our website, we used to call it fraud prevention, but we had to call it fraud awareness because it's hard to prevent, except just by you, the investor, doing your due diligence. And again, like I say, there's a whole list of government entities that are really, really, really wanting to help you. The desire to stamp out fraud is very serious with like the SEC and NASA and ASAA. They're very, very serious about wanting to stamp it out. So if you observe any fraud in your investment practices, let them know, and they want to be all over it. Hopefully that answers the question.
If I could just add, I think something that's really important she mentioned is doing your due diligence. We've seen it in our business, Karin sees it all the time, where obviously we've talked about self-directed IRA investing. There's a lot of opportunity for you to put money in deals. There's a lot of opportunity if you're doing deals to attract IRA money. And so if you are going to be the one putting money into deals, make sure you do your due diligence on the people syndicating or promoting the deal. Because there's a lot of times, unfortunately, where people will want to put money into a deal where if they just did a 5-minute Google search, you would see that the person behind it went to prison or blew something with the SEC, and obviously those aren't the people I would hope you'd want to be investing with. So just little things like that where you can do your own due diligence go a long way.
The other thing, just be careful of an unusual request for speedy response. So, okay, this is like it's on sale. This house is on sale, but we have to close it tomorrow. And it happens to be Thursday night, so that's your due diligence period and the period of time where you get to fund the money. Just pass. It could be the greatest thing in the world, but if you did it 10 times, you'd say goodbye to your money at least twice, and that was not a good idea.
Definite red flag.
Yeah.
Any other questions?
I have a question. There's a couple, too, up here. Defined contribution plan. Now, maybe that's the wrong thing. Benefit plan? Anyway, is there such a thing as putting a large amount of money in 1 or 2 years away for retirement? What is that?
Defined benefit.
What is that called?
Yeah, you kind of hit on. We touched on a little bit defined benefit plan.
Okay.
It's a plan that's out there that, as opposed to a defined contribution plan, which is like a 401k, which states how much you can actually contribute. It defines the contribution amount you can put in. Defined benefits set up so that you kind of calculate what's the benefit you want 10, 15, 20 years from now from the retirement account. And actuarially, they use calculations to back into what does the contribution need to be. Works really well for people that make good money who are also in their mid-50s and slightly older, just because they have less time to retirement.
Asking the question.
They have less time to retirement, so the amount that they can lump into the retirement account is a lot bigger. Now, you asked about 2 years. Generally, in my experience, the IRS wants to see these things respected and in place for at least 3 to 5 years before you kind of, quote unquote, change your mind. They want really to treat it like it's a real retirement account, not just use it for lump money in for 2 years.
No, I understand. In other words, money can stay there, but their size of contribution can be unusually large?
Yes. I mean, we've had clients that put in $100,000 a year. They've done $40,000. So it just depends on your business profit or, what your earned income is, all that good stuff.
Okay.
I'm sorry, I have a question for Bruce. Why do you do interest only?
Why do we do interest only?
Yeah,
because most of the loans that we do are short term. Even the ones that are 5 years, the amortization, if you did a 30-year loan and you amortize for 5 years on a $100,000 loan, you'd be owed $99,100. It's not a big factor for who's making the payments. And to be honest with you, it's just simpler. Our industry is just set up for interest only, so we don't really want to get into amortization. It makes our bookkeeping real simple. That's part of it, too.
Okay. It doesn't have anything to do with the franchise tax board. I know when a seller carries here in California, the buyer actually has to withhold every month a portion of the principal and send it to the franchise tax board.
Okay, I'm not sure what that has to do with, but I don't.
Okay.
Yeah,
when a seller sells their property and carries the paper,
Right.
the franchise tax board expects the buyer to withhold, if the payment is amortized, they want the buyer to withhold a percentage of the principal that's paid every month and send, it's a tiny check, but to send it to the franchise tax board every month.
Okay.
It's crazy. I didn't know if that had anything to do with what you were doing.
No, it doesn't.
Over here.
But it's probably
And that's
why
why you're
using a
sticking,
broker
yeah.
is a good idea.
I had a question for Matt, Amanda, and Corrine. On the health savings account, will the new healthcare law affect that or change that or alter that at all or have any impact on your health savings account?
I haven't heard anything that it would impact the health savings account at all. Now, obviously, things could change a year from now, but as it currently stands, I have not heard that that's going to be, the benefits of the health savings account would be taken away in any way.
I'd say you have to have a special kind of insurance plan called a high deductible health plan, HDHP. And if you qualify for that high deductible health plan, then you can have the health savings account along with it. And I also haven't heard of any changes.
Question for Bruce. You'd mentioned with the Dodd-Frank coming out, there'd be lots of private money on the sidelines waiting to see. Are private lenders not subject to the same rules regarding
Yeah, they're not. They wouldn't be because what they're talking about, a qualified residential mortgage, is going to be what's pretty much the standard now. So if you're a mortgage broker, that's what you're going to write because then you can sell it to Fannie Mae. You don't have to keep it in your portfolio. So private money will really be creating everything else that exists. And so they'll want to keep it in the portfolio because they can get a yield, let's say, of 5 to 6%, where that's pretty hard to do right now. So if you're in the bond world and you can say instead, like a PIMCO, that's why we had John Burns on the panel. He's the consultant for hedge funds and for builders, and that's one of the things they're very excited about is to know what the rules are so they can fill in the gap and get 5 or 6% yield on 30-year paper instead of, 2.6 on a 10-year bond. So they're actually very excited about it.
Nobody wants to ask that whether the three ladies up here all coordinated their outfits today, or come on, that's the first question we ask, right?
Hi, this question is for Bruce. You mentioned that they could do hard money loan on 10% of the net worth in exclusive, and not in addition to, but exclusive of the primary residence, right?
Yes.
What if they cashed it out? How long does that money have to leave the primary to become used as the net worth for the hard money loan? Do you know?
So you're a renter now?
No, like they didn't move out. Let's say the borrower cashed out their house to 90%. They moved the money outside of the primary.
That's a good question. I
That's
don't
net
know
worth
the answer
outside
to
of
that.
the primary, right?
Well, that net worth is no longer part of your house.
Right.
I would actually have to ask somebody else, to be honest with you. I don't know the answer to that. Anybody else?
It's still net. It's still net. Your value of the house, your debt, you still have a net there.
Well, but
it's outside of the
can't,
primary.
If you own your home free and clear, it's still not an asset they count. If you owe 100% of the value on your house, it's not an asset they count. It's a zero or it's a million. It's still a zero in qualifying over here. So you're saying over here is now the $1 million. I borrowed it or whatever. I don't know why it wouldn't count, but I'm not going to give you that as a final answer. It seems like it would.
Matt and I are going to attend a class in early November, specifically on these rules, so we'll let you guys know when we find out.
Cool, thank you.
Okay.
I have a question really quick about the charitable remainder trust. It works a lot like IRAs in some respects. Are there any disqualified persons that can't be trustee, or are there any rules that we could be made aware of?
Of what kind of trust?
Charitable remainder, like a CRUT?
Oh, yeah. There are some people, but it's not as bad as you would think. And in some cases, you can be the trustee of your charitable trust. So they're not quite as strict. I did think, by the way, besides the IRA prohibited transactions, nonprofit board of director transactions, interested director. That's the only other time I see those rules that strictly. So charitable remainder. The issue with being a trust, you can be your own trustee of a trust, In most of the trusts, it's the same issue. If you have too much control, then it will be deemed to be yours and it'll come back into your estate. So you can be the trustee, but then you'll have to give up some other controls in it. Again, it's that balance.
Can the charitable remainder end up being a family foundation?
It can, but then your donation rules are restricted to the family. So instead of the 50% limitation, now we're at a 30% limitation on your charitable deduction.
If your head is starting to hurt, you feel just like I do. It's okay. Can a charitable remainder...
I gave you all those pretty charts.
Can a charitable remainder trust invest in trustees?
Yes. Mm-hmm.
I just had to ask.
Right. Just totally off the top of your head, no reason.
Another question. When you're talking about an actual appraisal, it has to be an appraiser, not a broker price opinion. It has to be a physical appraisal. Every year, if there's a physical asset in the charitable remainder trust?
If it's in the unit trust, right,
Yeah.
it would be. The IRS's rule is the appraiser has to be someone licensed to be an appraiser or someone who is in the business of doing appraisals on a full-time basis consecutively for X number of years. So I think they're not saying you know a BPO is not going to count, but in my experience, for people making these kinds of donations are large in value, and so it really is to your benefit to get true appraisers rather than just like a BPO.
And should the gift tax return get audited, that's your expert witness. Your first expert witness is the person who did the appraiser, so you want it to be a good one. Interesting. And not, the regular accountant who does your taxes all the time is also going to do your appraisal and stick it. That's not going to fly.
Yeah, so we don't do appraisals for our clients.
Yeah. I felt comfortable in saying that in front of you.
I have a question, I think, for Teresa. For the irrevocable trust, you had said there was 2 appraisals, one for the property itself and then one of the LLC.
Right.
How do you appraise an LLC?
Well, I don't because...
I mean...
No, I know what you mean.
And
I'm
then
kidding.
what would that cost? So if you're holding property and property's there, where's the rest of your value?
The rest of the value is actually the discount part of it. So what they do is they analyze if it's a brand new LLC, it's a relatively simple appraisal because they're just looking at the value of the property and what restrictions are on the interest in the operating agreement that we've drafted. But they can still be thousands of dollars because they're on the hook for them as well. So the real estate appraisal will cost anywhere from, depending on who you get, a few hundred to a few thousand, and then the LLC, the business valuation is usually more expensive than the real estate because that's where the risk is as well. But that's also where the savings comes in, where the discounts are.
That's the part that confuses me.
It confuses most of my clients when I explain they have to pay for 2 appraisals.
That's what I'm trying to get my head around.
Yeah.
I have an LLC and it's holding, whatever, $100 in value.
Right.
And then you have that property value.
Right.
Then, oh, I'm sorry. What's the value in the LLC?
Okay, so
outside of that 100, and I understand that's where the discounting's coming from.
Right.
I'm trying to understand, what are you discounting in the LLC?
What we're now appraising is that 10% interest that's been given away. So now the irrevocable trust or the children or whatnot are holding 10%. So what the appraiser is going to look at is what's the value of that 10%. If that child tried to turn around and sell that 10% interest in the LLC, what is the open market likely to pay for that? So if I said to you, I've got a 10% interest in my parents' LLC. By the way, sorry, my mom and dad manage it for the rest of their life, and when they're done, it's my brother. So you don't never have any say-so over it. Also, before I sell it to you, I've got to offer it to them, and they might be able to buy it for a little bit less based on the formula in it. The appraiser isn't going to say well, in yours it was $100 and I'm giving away 10% of it. They're not going to say that's worth $10 because it's too restricted. You wouldn't pay me $10 for that. You would pay me $10 for 10% of $100, but you wouldn't pay me $10, this is the theory. Right. You wouldn't pay me $10 for an interest in the LLC my parents own and control and that you're never going to have any say-so over. You won't even have any say-so over whether or not you ever get any income out of it.
Right, because it has limited marketability.
Right, so that's one of the discounts, and limited control, so that's the other discount.
So I heard you say it costs more to have that determination.
The appraisal costs a little bit more.
Right, so can you give me a benchmark for that? And the other question would be, I just went blank. Just answer that one, please.
Okay, and then the second one will come along. It depends, everybody's favorite lawyer answer, on what's being appraised in the LLC and how long it's lasted. But the cheapest I've seen is like around $3,000 to appraise an LLC, but it goes way on up from there.
I remembered. Thank you. And what type of appraiser does that?
They're business valuation appraisers, so they're specialized in appraising businesses like this.
CPA,
they're not real estate appraisers.
Like a CPA with a specialty focus for that
Some
area?
of them are CPAs. They're not necessarily CPAs. They're certified appraisers and business valuations.
Thank you.
Mm-hmm.
Well, Rick, if you want to get your fees bumped up, you know what you got to appraise now.
Is that your real estate appraiser?
Yeah.
Yeah, I think typically the business appraisals, I mean, they don't necessarily have to specialize in real estate.
Right.
Because that part's already done. They're just looking at the LLC itself. And that the LLC could be any kind of business. It could be a dental office that you're passing off or, anything in general.
Okay, I have a self-directed tax question. On the self-directed IRAs that have a loan against them, then you're taxed for the percentage of the loan. Is that only equity when you sell it, or does that include rental income?
What you're talking about is UDFI taxes and related debt-financed income. Unfortunately, the answer is both. So you potentially have UDFI taxes if you ultimately have a gain, and at the time of the sale, there's still debt in that investment. Or if you're holding onto the real estate during the holding period, if you happen to have net taxable income, then part of that could be subject to UDFI as well. But keep in mind, for real estate investors, we always have our write-offs, right? Especially if we have debt, there's mortgage interest, there's taxes, there's depreciation. And so you would only have to pay UDFI taxes if after all those expenses, we still had taxable income.
Karen, are there any IRS requirements for real estate in IRAs? Are they expecting to see any kind of annual reports?
When you have a regular IRA and it's in the stock market, it's already public knowledge what it's worth. When your self-directed IRA holds an asset that's an alternative asset, it's not public knowledge. So every year we send a letter and we ask you to give us a valuation. It can be an opinion of value, could be from a CPA or a BPO or something like that. But when it's a taxable event, when you're going to take your IRA and convert it to Roth, for example, or maybe you're going to sell some assets so you can take your RMD, your required minimum distribution, when you're 70 and a half. If it's a taxable event, you have to get a full appraisal from a qualified appraiser like they're talking about. I mean, in this case, it would be a real estate appraiser. So those are the requirements.
I do want to add one more tax that you need to think about, which is property taxes, especially since a lot of you own real estate. If you do any of the kind of gifting that we talked about, we have to be very careful to take into consideration property tax reassessments. I see a lot of the forming the LLC and making the gifts with family vacation homes that have been in the family for a long time. I have a client who did it with a 6-unit apartment building right down in Laguna Beach, practically beachfront, and the property tax value that it was at was very, very important for them to keep. So there is a parent-child exclusion with some limits for transferring property, but that does not apply if what you're transferring is an LLC interest. So if you transfer more than the parent moves the property into the LLC and then starts gifting the LLC interest, once you click past 50% transferred of the LLC interest, the underlying property gets reassessed. And that can be brutal. That can use up a lot of so you do have to be very careful and plan around that. Sometimes we plan around that by making some of the gift, we just give up the discounting and make some of the gift just directly parent to child and then the rest of it through the LLC.